China just cut off two European banks and exposed Europe's economic fragility. Without warning or negotiation, China has severed two European banks from its financial system. Lithuania's UAB Orbo Bankas and AB Monobankanka were declared persona non grata by Beijing's Ministry of Commerce, effectively banning them from conducting any transactions in the world's second-largest economy. The move came in direct retaliation for the EU's decision to sanction Chinese banks over their ties to Russia. A tit-for-tat exchange, but one that laid bare just how little economic leverage Brussels holds when the battleground shifts from politics to real-world finance. The EU denounced Beijing's action as groundless. But outrage doesn't move money, and overnight, Lithuanian banking access to Asia disappeared. The timing was anything but accidental. Europe is already reeling. From self-imposed embargoes on Russian energy, from subsidies bleeding public budgets dry, and from a desperate scramble to replace one lost commodity source after another. While Brussels continues to frame sanctions as a moral necessity, Russia's economic data tells a different story. According to projections from Russia's finance ministry, non-oil and gas revenues, from metals to agriculture, continue to climb steadily. This growing disconnect, Europe hemorrhaging capital while Russia adapts, undermines the core assumption behind EU sanctions, that they hurt Moscow more than Brussels. Beijing clearly saw the vulnerability and struck where Europe is least equipped to respond, financial connectivity. And while the latest blow landed on Lithuania, the message is meant for the entire bloc. In Italy, Prime Minister Giorgia Meloni's government is now drafting plans to reduce Chinese stakes in the country's most strategic companies. At Pirelli, where China's Sinochem holds a 37% share, U.S. pressure is already causing export headaches. Washington has labeled Chinese ownership a national security threat, complicating supplies to Formula One teams and even jeopardizing Italy's access to American markets. Meloni's strategy is straightforward. Push out Chinese shareholders to avoid U.S. retaliation. But the logic begins to unravel on closer inspection. Chinese investment provides smoother entry into Asia's massive markets. Cutting ties to appease Washington means sacrificing growth opportunities just to avoid penalties in an American market where tariffs are already eroding profit margins. The real scale of the trap lies in the numbers. European companies are currently engaged in over 700 joint ventures with Chinese investors in Italy alone. These aren't marginal holdings. They span critical sectors like energy, transportation, finance, and advanced manufacturing. According to Bloomberg, Chinese stakes include assets like CDP Ready, which manages Italy's gas and power networks, and Ansaldo Energia, a major power plant producer. Removing Chinese capital to comply with U.S. demands would create funding gaps so vast that no European treasury could realistically cover them. Meanwhile, Washington is escalating beyond tariffs. Treasury Secretary Scott Bessent recently warned that under pending legislation, Trump could impose secondary tariffs of up to 500% on countries still purchasing Russian oil. Reuters confirmed the language in August. Such a figure is less a policy and more an economic shock tactic, a weapon designed to enforce alignment through fear, not diplomacy. And here lies the stark contrast. While Europe debates de-risking, China has already surged ahead to become the EU's largest trading partner, with over 856 billion euros in goods exchanged last year, eclipsing trade volumes with the U.S. The EU can't pivot away from China without detonating its own economy. But it also can't defy American demands without risking crippling tariffs that would crush what's left of its industrial base. Trump's tariff machine is the common thread running through it all. Even before this latest escalation, U.S. duties on European steel, automobiles, and machinery had already stripped billions from EU trade surpluses. Now, with new chip tariffs announced on August 15th, potentially rising to 300%, Washington threatens to destabilize the global electronics market altogether. The Philadelphia Semiconductor Index dropped over 2% following the announcement, while Intel, insulated by U.S. subsidies, rose nearly 6%. Market logic has been turned on its head. Washington is picking domestic winners and leaving everyone else to sink under the weight of artificially inflated costs. The contradiction is glaring. Tariffs intended to reshore production are simultaneously punishing allies whose cooperation the U.S. demands. Then came Besant's ultimatum. Standing on U.S. media platforms, he made it clear Europe must either impose its own penalties on BRICS countries or risk facing Trump's wrath, likely in the form of double tariffs on European exports. This was no suggestion. It was a threat, and the irony couldn't be sharper. The EU already imports more from BRICS countries than the U.S. ever has. Over 23% of European trade is with BRICS and its partners, compared to America's 16%. The dependency is one-sided. BRICS can find alternatives. Europe cannot. To follow Washington's lead and sanction China or India would mean economic self-destruction, essentially hammering nails into Europe's own industrial coffin. Nails quite possibly made in Shenzhen. Yet the pressure is mounting. Since 2020, Europe's trade deficit with China has doubled, as cheaper Chinese goods continue to replace domestic production and supply chains Europe once dominated. The battlefield has moved, and Europe, caught between its two largest trading partners, may be running out of moves. Germany's automotive sector, once the gold standard of global manufacturing, now finds its parts less competitive than those made domestically in China. Machinery exports, once the engine of German economic growth, are collapsing as Chinese firms increasingly self-supply at lower cost. To keep what's left of European industry alive, the EU needs to sell to the United States. But to do that affordably, it relies on Chinese components to keep input prices down. And here lies the central contradiction. To access the U.S. market, Europe needs China. To appease the U.S., Europe must punish China. Each path cancels the other. The result is paralysis. The trade data tells a story. Last year, BRICS countries exported over $750 billion worth of goods to Europe. Europe, in return, shipped around $450 billion. But those headline numbers conceal a critical detail. The imports from BRICS are mostly raw materials and intermediate goods, the very skeleton of Europe's manufacturing economy. Cut those off, and the consequences are immediate. German factories grind to a halt. Italian energy firms lose essential feedstocks. Spanish transport systems stall. A tariff war with BRICS isn't a future threat. It's a suicide pact in waiting. And yet, saying no to Washington has consequences of its own. Trump has already warned that if Europe refuses to align, tariffs on European cars could jump from 15% to 30%, vaporizing Germany's industrial base just as Beijing shuts off financial channels. The crisis sharpens further through the lens of semiconductors. Trump's proposed 300% tariffs on chips aren't bluster. Speaking aboard Air Force One, he explained the mechanism. Chip makers that build inside the U.S. are spared. Those that don't are hit with tariffs that escalate until relocation becomes inevitable. It's coercive industrial policy by design, meant to uproot tech giants like TSMC, Samsung, and Tokyo Electron from Asia and transplant them into the U.S. To Washington, this is a national security imperative. To the global economy, it's disruption on an unprecedented scale. And while American consumers may eventually pay the price, Europe will suffer first and hardest. From cars to defense systems, European industries rely on advanced semiconductors they can't afford to source under triple-digit tariffs. America frames this as a move towards sovereignty, but every escalation seems to shrink Europe's own. China retaliates when sanctioned. The U.S. threatens punishment even when obeyed inadequately. Brussels, caught in the middle, is cornered, punished if it complies, punished if it resists. The question now is no longer whether Europe can balance its alliances. The real question is whether Europe has any meaningful agency left. In a world where both superpowers weaponize trade and finance, neutrality isn't strategy. It's a vacuum waiting to be filled. And China isn't standing still. Last year, Beijing increased R&D spending on semiconductors by 20%, par a five-fold rise in total research investment over the last 15 years. In raw dollar terms, it is fast approaching parity with the U.S. In output efficiency, it may already be ahead. So while Washington's tariffs may delay Chinese chip imports, they could just as easily accelerate domestic Chinese innovation. And if the U.S. blocks advanced chips, Beijing can retaliate with restrictions on rare earths, crippling production of magnets, batteries, and weapon systems the West cannot quickly replace. Europe, Trapped between these two forces, becomes collateral damage in a war of attrition it neither started nor can end. And the irony is brutal. Europe helped design the modern global order, founded on free trade and multilateralism. Now those very principles are being dismantled by its own allies. Brussels imposes sanctions in defense of rules. Beijing retaliates outside those rules. Washington rewrites them altogether. The EU talks of strategic autonomy, but its industries are tied to Chinese inputs. Its exports chained to American tariffs, and its financial system vulnerable to permissions that Beijing can revoke overnight. This isn't leadership. It's reaction. Europe isn't playing the game. It's being played. A pawn on a board where the queens already know how it ends. And the picture is bleak. Factories in Wolfsburg waiting for parts from Shenzhen. Banks in Vilnius locked out of Shanghai. Diplomats in Brussels awaiting the next directive from Washington. Traders in New York placing bets on the next tariff to fall. This isn't sovereignty. It's exposure. China cuts off banks. Besant demands punishment of BRICS. Trump threatens 300% chip tariffs. And in that moment, Europe realizes the real crisis isn't about China or Russia. It's about the collapse of Europe's leverage in a world where power no longer flows through consensus, but through coercion.